Have you ever wondered how the 2008 financial crisis could have happened? Could there have been a fundamental flaw in our understanding of economic markets? Let's take a moment to delve into that. The 2008 financial crisis was a pivotal moment in history that shook the global economy. Many explanations have been put forth, but one that stands out is George Soros's concept of reflexivity. Reflexivity is a theory that posits that markets are not just influenced by external events, they also shape them. In essence, it's a loop where the participants' views and actions impact the market, which in turn influences their views and actions. In the context of the 2008 financial crisis, we'll explore how reflexivity played its part. We'll delve into the dynamics of mortgage origination, interest rates in the US, and how these elements were influenced by the reflexivity loop. This journey promises to be a fascinating exploration of the complex dynamics of financial markets and the intriguing concept of reflexivity. George Soros, a prominent figure in the world of finance, proposed the concept of reflexivity. But what exactly does it mean? Let's delve into this intriguing concept. Reflexivity, in its simplest form, is the idea that our thoughts, beliefs, and actions can influence the realities we experience. In the context of financial markets, it suggests that the perceptions and beliefs of traders and investors can often drive market values, not just the fundamental economic factors we typically consider. Imagine a bustling stock market. Traders are busy buying and selling shares based on their perceptions of a company's value. These perceptions, in turn, are influenced by a myriad of factors, from a company's performance and industry trends to global economic conditions and even the mood of the trader. Now let's add reflexivity to the mix. This concept posits that the trader's perceptions and actions can, in fact, influence the company's actual value. It's a feedback loop, if you will. If traders believe a company's stock is valuable and invest in it, this can drive up the company's market value. Conversely, if traders believe a company's stock is overvalued and start selling, this could lead to a decrease in its market value. In this way, reflexivity proposes an interplay between our beliefs and the reality of financial markets. It's a dance, a dynamic interaction where the dancers, the traders and investors, and the dance floor, the market, are constantly influencing and reshaping each other. But reflexivity doesn't stop there. This concept also suggests that our beliefs can, in fact, distort the reality of financial markets. When traders and investors act on their perceptions, they can create price bubbles or crashes that defy economic fundamentals. This distortion can then feed back into their beliefs, perpetuating the cycle of reflexivity. In essence, reflexivity suggests that our beliefs can shape the reality of financial markets. This is a radical departure from traditional economic theories that view markets as inherently stable and rational. But as we'll see in the next scene, this concept has profound implications for understanding financial crises, including the 2008 financial crisis. Now that we understand reflexivity, let's delve into how it played a role in the 2008 financial crisis. Picture this. It's the early 2000s and the US housing market is booming. Banks and other financial institutions are giving out mortgages like hotcakes. This is our starting point. People's perceptions of the housing market, that it was a surefire investment, led to increased demand for mortgages. The more people believed in the housing bubble, the more they were willing to borrow, and this, in turn, led to an increase in house prices. However, reflexivity comes into play here. The rosier the outlook on the housing market, the more willing the banks were to lend. This created a self-reinforcing or reflexive loop. Increased lending led to higher house prices, which reinforced the perception that housing was a good investment, leading to even more borrowing. Now let's shift our focus to the interest rates. During this time, interest rates were relatively low. This made borrowing cheap, further fueling the demand for mortgages. But this too was influenced by reflexivity. As the demand for mortgages increased, the perceived risk of lending decreased. This resulted in even lower interest rates, which further stimulated borrowing. But as we now know, this couldn't go on forever. The housing market wasn't as sturdy as it seemed. When the bubble burst, house prices plummeted. Suddenly people found themselves unable to repay their loans, leading to a wave of defaults. This was the trigger for the 2008 financial crisis. Reflexivity played a crucial role in this crisis. The perceptions of the market participants influenced the market conditions, and these conditions, in turn, reinforced the perceptions. This feedback loop, driven by reflexivity, created a bubble that eventually burst, leading to one of the worst financial crises in history. The 2008 financial crisis was a stark example of reflexivity in action, where perceptions and reality fed into each other, creating a vicious cycle. The 2008 crisis left a profound impact on the world, but what lessons have we learned from it? The aftermath of the 2008 financial crisis was a time of reckoning. Financial institutions worldwide faced a new reality, one where they had to grapple with the consequences of their actions. The crisis brought to light the systemic risks inherent in the financial markets, risks that had been largely ignored in the pursuit of short-term gains. In response, regulatory reforms were implemented to mitigate these risks, such as stricter capital requirements for banks and enhanced consumer protection. These changes aim to create a more resilient financial system, better equipped to withstand future shocks. A key insight is that the concept of reflexivity can help inform regulatory policies. By considering how market participants might react to new regulations, policymakers can anticipate potential unintended consequences and mitigate them. The 2008 crisis taught us that we are not merely passive observers of market dynamics. We are active participants, capable of influencing these dynamics. And with this influence comes responsibility. In the world of finance, awareness and understanding of reflexivity can be our guide in the complex maze of market dynamics. We've journeyed through the concept of reflexivity and its role in the 2008 financial crisis. But what are the key takeaways from our discussion? Our exploration began by illuminating reflexivity, a concept coined by George Soros. Its essence lies in the interplay between our perceptions and the realities they shape. This dynamic interaction alters the landscape of financial markets, where reflexivity isn't merely an academic theory, but a living phenomenon with tangible effects. One of the key illustrations of this was the 2008 financial crisis. We delved into how reflexivity shaped the dynamics of mortgage origination and interest rates in the U.S. The market's perception, built on the belief that property prices would perpetually rise, led to risky lending practices. This, in turn, shaped reality, creating a property bubble that eventually burst, triggering the financial crisis. This chain of events underscores the power and potential danger of reflexivity. It's a reminder that our collective perceptions can create realities that may sometimes be far removed from the underlying fundamentals. Moreover, it emphasizes the importance of understanding reflexivity and navigating financial markets. It's not just about predicting trends based on historical data, but also about understanding how our perceptions can change the course of these trends. But reflexivity isn't just a warning, it's also an opportunity. By understanding how our perceptions shape reality, we can better anticipate market shifts and respond proactively. It allows us to see beyond the numbers to the human beliefs and perceptions driving those numbers. This understanding can provide a competitive edge, allowing us to make more informed decisions in an ever-evolving financial landscape. Understanding reflexivity helps us see financial markets in a new light, offering vital insights into the intricate dance between perception and reality.